The two most important things we should be doing with portfolios right now: holding our nerve and preparing for the long trades. Gary Glover from Novus Capital is walking us through these key points at a critical time in the markets. Good morning, Gary. How are you?
Yeah, I'm good, Chris.
So, report this morning. Yesterday I was happy to read that. You've walked through a few things this week. You've got what we're looking at, the standard share market indice updates and some trading shares to look for with opportunities, plus the alarm bells to look for. And most importantly this week, you've taken a detailed look at the midterm years. You've dusted them off as part of your roadmap that you normally use. And that's also partly from audience request, where people are saying, look, how is this working and how is it that you're getting the timing so spot on? Should we start off the report by looking at your normal indices and see if there are any changes on that front?
Yeah, we can look at the US market there. I mean, they're sort of, they're tracking pretty well. We had that little outside week there last week, which I think, the volumes were, okay without being great on there. And then I just thought that was, you're going to see a few little bounces along the way here, which is exactly what that was. And then, we literally got an outside week last week. So we got a really bearish week, obviously. Finished higher and then, finished on the low, basically encompassed the previous week. And then the volumes were up as well. There's some pretty heavy sell days down there. So at this stage, this is pretty aggressive here so far, the sell-off. I know we had that little 1 week snapback here, but this is looking more, to me, this is looking more like a new low rather than a sort of high low. The sort of the 60 years sort of pattern, and then, quite a few of the other midterm years can make high lows in October, but they don't look like this. They've been more of a sidewaysy sort of time-consuming, sort of slower decline. This has sort of so far it's had an impulsive, 3 weeks down, 1 week up, and then outside week bang, so seeing a bit of selling volume in there as well. So that's just, so far that, indicates a deeper low here. So I do favour a new low here for the US market. And just maintain those short positions for the time being here. The only thing about this cycle is that normally there's a sort of the more bearish the cycle, the faster it will happen. Whereas if it's sort of more a time consuming, a higher low, it'd probably take more time here. So just might mean that maybe the low comes in early October rather than sort of mid or late October. But yeah, we'll keep an eye on that as over the next few weeks here. But I still think, the S&P and the NASDAQ both sort of looking pretty weak here, both outside weeks and both heavy volume. And I just think we're going to come back to some levels. So we'll watch those technical levels over the coming weeks here, but still looks pretty bearish to me.
So when you say the more bearish it is, the faster the cycle, you're talking about how quickly we come away from that recent rally that we had.
Yeah, that's right. Yeah.
Come back down towards the lows.
Yeah, yes, that's exactly right. So far it's been pretty impulsive on the way down. So, pretty aggressive down a couple of weeks, it's fallen pretty quickly. Had one little outside week, and then within a week we've taken that low out again. So just doesn't leave it in a strong position here. So typically when you see a really impulsive sell like that, that normally infers a new low most of the time. So if that had sort of squared off a bit more, and if the angle wasn't as steep on the downward, say it was coming at 45 or something like that, then we might sort of see a higher low here. It's just, so far it's just looking a little negative here. So yeah, and there's plenty of good reasons for that too, Chris. I mean, we've got, inflation's pretty high. Obviously, we're going to be, really aggressive pushing rates here. The Fed's already indicated they're going to have to go pretty aggressively here. So whether that's 75 or 100 basis points, those sort of moves are pretty large. And they take a few months to sort of to kick in as well. So we mightn't be sort of seeing any pain now, but 100 basis points and then another, lots of 25s and 50s, or that can hurt. So if the Europeans are hurting from energy prices, then they're going to be hurting from higher rates as well. So so just a little shock for the system here in the short term, but but yeah, at this stage, I'm just looking at the price action is so far, it's still pretty negative here. So we just got to respect what the charts are saying here, and that at this stage they're indicating more downside there. Same with the XJO as well. It's sort of had a pretty impulsive down week last week after trying to bounce and rally. It sold off pretty aggressively. There's some decent volumes there last week on the downside as well. So there's some pretty heavy selling days as well down there last week. So yeah, again, that's probably suggesting we might come back a bit lower here. So
well, that's a good point, because in this week's report, you've mentioned our exposure to the commodities and how the commodity cycle can often, so the bonds move first, the equities, and then the commodities. So are you kind of leaning towards maybe the Australian market edging out lower later or something along those lines?
Yeah, so I'm trying to prepare myself for the low here. Hopefully, if it all goes to plan here, and we see a low here in the next few weeks, then what are we going to trade on the long side here? My only concern here is looking at similar cycles is that the commodities, as you say, bonds go down first, and then equities, and then commodities. So commodities can lag here, and in this cycle actually, so in these midterm years, and also in these sort of second year of the decades, or is that commodities can get dragged down here. So in 2002, 2003, I think our market, bounced with the US market, but we came back to a new low in 2003, while the US market made a higher low, went higher. So that was, commodities came back a bit deeper there. And also I think 92 as well was a similar cycle. We got dragged down by commodities again. So this sort of cycle is just telling me that commodities might, our market might go a little lower here. So I think in that 92, I think US market found a low in October, and I think we found a month in November a low. So we continue to go down a bit further. So a little bit of a quandary there in terms of how do we get long equities but not without industrials. So like a lot of the funds would have resources in them, which is obviously we're a resource-laden index. So really looking at probably trying to get, probably get a bit more skew on the US and a little less skew on Aussie, and then just try and be a bit more industrials orientated. So and then when resources find a low, maybe a month later, then try and add them in there, So that's going to be the tricky component here, because it doesn't always match up exactly right here. So I can just sort of see that unfolding here. So that's our little quandary there at the moment for our market.
You've given some hints a little bit later in the report as to where we could be looking to that specific industrial exposure. But before we get to that, you've helped us and brought in the chart. So if we look at the Dow Jones, you've put the 60-year cycle in here, still going to script.
Yeah.
So for those who have been watching for some time, they know that you're sort of calling a high late 2021. Mid-June low, then the mid-August rally for a lower high, and you've said for some time now that sort of the mid-October low. That's all coming off the 60-year cycle, is it? Is that sort of the main print happening here?
Yeah, so you got the midterm year, which is obviously it's got its cycle. You've got the 10-year cycle, and the 60-year is probably the one that's been the closest to. So the funny thing is they're all pretty similar. So that's why we've had a pretty good, most of the cycles have all been, in somewhat agreement. So they're very, very similar in their structure, but the 60 years probably been the one that's sort of been the closest. But yeah, that's why there's probably been a degree of confidence issue. I mean, sometimes the cycles can be all looking different, and then that makes it a bit tricky. Other years, everything can just line up together very similar. So that gives you sort of more confidence with your roadmap here. The only thing I've noticed here is that when I look at sort of lows in these sort of 10, 60-year and midterm years, is that there's a couple of different structures there. I say that the higher low will take a bit longer, and the new low happens a bit faster. So far, this decline here is happening reasonably fast. So that does infer that we might go to a new low here, looking at how aggressive that sell-off is so far, and it might come in quicker as well. So that low will come in faster than something which, so instead of being sort of mid to late October. It might be early October. That's the only sort of subtle difference in these cycles here. So yeah, I'll just be watching, see how that moves there. So if we go to a new low in the first week of October there, yeah, that'll be probably when I'm looking to unwind some of my shorts and then start to sort of start building a long portfolio. Just gotta get the long side right here. I thought we just sort of bounced it, but when I looked into the cycles, I was just I was so quite surprised to see that our market actually dragged on a bit longer, went a bit deeper than the US market, which is quite surprising. Normally we're sort of normally in these sort of cycles we hold up better, but this is inferring that the US, you actually want more US exposure this on the next low. So yeah, so it's just interesting. So
that's a good point to look at as to how to build the portfolio when that low does eventuate. You've put in a couple of companies to look at. So you've mentioned in the last couple of weeks and months that you're favouring healthcare for many reasons on the macro side of things. You've also looked at Ramsey sort of in the daily. You've got the weekly chart here. So what's the importance of the red line and this green line? Is this like, we've got some touches here. So is that like a trend line of higher lows and support?
Yeah, just an old support line is the red line there, but we've also got our Fibonacci level just around that point, and that's also the point where the last low was, and that's also the point where this is where the stock was prior to this takeover bid, which never really was, I guess you might sort of say. So yeah, it was sort of non-conditional, sort of yeah. So they're the ones that sort of tend to sort of fail the most,
like it has.
Yeah, it is. They're the ones that don't occur too often, So yeah, so like I had a few clients who had some Ramsey, and I think a couple might have sold it, but majority we just wrote some deep in the money calls and just sort of tried to hedge some of the downside there. But happy to hold on to it here. Probably happy to sort of build a bit more of a position here. Anything sort of down there 61, 62 is probably good buying in my mind here. I just figured that it's been a couple of tough years there for these private hospital operators. Obviously the ones that do a little bit of COVID stuff there have done okay, but all your sort of day surgeries and just elective surgeries are all being sort of held back here. So there'll just be a backlog. I mean, you can read about it everywhere. There's a backlog of sort of these things. So I just think the next few years will be quite robust for healthcare. So I think it'll be a sector which does quite well here in the coming years. Just probably weren't going to report so well this year, which they sort of haven't, unless you've had a little bit of COVID stuff there. But yeah, I just like that sector. It normally does quite well, inflationary periods as well. So I just think it's a pretty safe sector to be in there. The only thing that worries me,
what's that?
Only thing that worries me a little bit there is I've just sort of noticed that a lot of hedge funds and a lot of money is already positioned there already. So a lot of people think in the same way I am. So that worries me a little bit. So I don't like everyone being in agreement, because then that worries me that I'm wrong. But yeah, I think there's some value there and some safety there. So yeah.
Well, you did make that point last week that the rest of the market was positioned for such a positive view on the inflation print that you saw the greater risk being to the downside. You called it well, you traded it well. Monday, Tuesday, you were buying bearish ETFs, and that played out. So right to be concerned if you think the rest of the market's seeing the healthcare space as a place to be. That's
yeah, I guess. Well, some of the hedge funds are already sort of got some weight in there already. But look, the one thing which is obvious, there seems to be a lot of cash on the sidelines. So looks like there's money ready to come back in here. I just looking, waiting patiently to come in. So, yeah. But look, I guess the sector I should be waiting for. I mean, that Healius looks pretty good to me. That like I think it's on a P of around 6.5, 7 or something there. The yield's around 4.5%. So I'd expect that yield to go up there on a better result. And I mean that 330 levels, the old high there back from sort of 2018, 2019, big sort of fib level. Just, we saw a little bit of a bounce off that a couple of weeks ago after the result. Thought that was sort of a bit of bit of a signal there, but just think the market might just sort of drag it back a little bit here. But I think around 332 is looking, looking pretty good value-wise. I think good sector there. So, yeah, just worth looking at a starting position there for these stocks here. So, yeah.
That's one to look for when you talk about market cycles, higher lows, when the market's reaching lows, whether that's the US market reaching a low or the Aussie, you're still looking for higher lows, the likes of those healthcare companies and home consortium as well. Does that fit into that bucket?
Yeah, I mean, there's also just some good volumes in those healthcare stocks as well. Sort of some pretty decent sort of activity there in the last few weeks. So sort of starting to see, so we should sort of see some early signs of accumulation taking place there. Not any weakness there. That home consortium there actually is one I've sort of seen had a fantastic run there sort of in the last year. It's had a reasonable decline here. But yeah, I like the fact that it's actually showing some relative strength here at the moment, really holding up quite nicely. There was some pretty good volume there last week and then finished on its highs. So I'd love to see this maybe just congest a bit more here over the next week or two. Holds that position in place there. I think it could punch through that and go high there. So yeah, that does look pretty interesting there. That the volumes are quite good. Those good volumes at the low, just pretty light volumes on the pullback. So that looks pretty constructive. Next chart's probably the one that's the most interesting to me.
Well, you did mention it last week. We spoke about it on Friday.
Yeah.
You looked at a few coal companies and you said, look, there's exhaustion, and you were alluding to these rising trend lines. So can you just walk us through, for those who weren't listening on Friday, what the 1, 2, 3, 4 is and why this is such an interesting chart?
Yeah, so I learned this actually from Bill McLaren actually years ago. He used to sort of talk about, there's sort of different types of trends, sort of like a normal, sort of fast trends, and then, corrective overlapping trends. And then occasionally you get what you call these vertical or blow-off trends. And they occur when you get 3 ascending trend lines on a weekly chart. That's when you're getting a market that's really getting elevated, starting to really sort of accelerate. And sometimes you can get a fourth, not very common, but sometimes you can get a fourth ascending trend line there. So these are basically a vertical trend. So you can't keep going up at this sort of rate here. These vertical blow-off, these vertical trends here, once they break, they normally have very large declines, Chris. And so normally the ones that do the 3 ascending trend lines, they'll come back to where the third one started, which is in this case is around that sort of 250 zone. But we've got a 4th ascending trend line here. So that's our sort of target, is come back to 450, which is about sort of half. So we're basically calling a half in these stocks here at the moment. So look, no one's going to sort of, everyone's going to disagree with that view. This is just a technical view entirely. So, but look at the moment, obviously, you've got energy issues, around the world here. But you might argue that they're priced in here as well, Chris. There's probably no good reason to sell these here based on the current climate there, but oftentimes that is the right time to sell them when there is no good reason to sell them. That's, it should be as good as it gets sometimes is when highs come in, and it should be as bad as it gets when lows come in. So can coal prices get any better? Can the segment be, so again, you're pricing in a lot of stuff moving forward as well here. So that's just a big vertical move. I mean, it's gone up sort of 10, 12 times there. So pretty similar sort of, pretty similar multiplication of the previous leg. So if the viewers were to look at a 10-year chart, to look at the previous leg up, going up into, it might have been 18, 19 top there. That had a similar move. I think it went from like 50 cents to $6. Almost went up 12 times, something like that. So, but yeah, I'm saying this, this is a textbook sort of vertical top, which McLaren talked about his teachings there, and they all come back here. To be honest, I learnt McLaren's work. I've seen quite a few vertical trends. I've never seen one not come back to the last acceleration point. So I'm still, at some point we might have one that does something different, but I've never seen any vertical trend not come back to that first 10. Most of them actually come back to where the third one started.
Which is for Whitehaven, as you were saying, so that 250 region.
Might take a while to come down there, but Yeah, but the first leg down, that 450 zone, that can get punded up reasonably quickly in most cases here. So look, there's no good reason to sell coal. I know there's energy issues out there at the moment, and obviously, we spoke about inflationary years and pressures there. Obviously, your energy is your top performing sector there. But even if you go through and look at those 70s results there were some big years where the market was up 100, 200% in energy prices. But then there were some years that were off 30, 40% as well. So performed well over the whole, 8 years or the whole inflationary period, but there were some big up and down years within there. So what's to say this doesn't cool off here? What if energy prices start to sort of cool off here? So what if the oil price cools off, coal price cools off, and everyone thinks, okay, we're peak inflation. So that might cause these things to come off, and that's maybe when equity markets find a low and start to rally. And then you find in those inflationary years, there was some definitely in the 70s and 40s, you saw some big moves in the market. So big moves up, big moves down here. So everyone might get excited for the first year about inflation coming off, and then it might start to rear its head again. And maybe something like these energy stocks and coal stocks, maybe they go back to retest. So maybe they plunge to 450, they bounce back up to $7.50, $8, go back up to retest the high again. But it can be very volatile periods. That history has just sort of said, though, you can get big moves up and you can get big moves back down again, and then you can go back and retest them again. I think it was the 70s there. I think some of the moves, I'll put some charts in there, but I think, I remember sort of looking at charts there in those high inflation periods where we saw like, there was like 70% rallies and then 40% declines. And there was like 3 of them over like 8 years or something, so big moves up, big moves down, big moves up, big moves down, big moves up, over, so there was, depending on what year you were in, over that 8 years in that inflationary period, you could be up 70% or you could be down 40% the next year. And then the next year after that, you're up 70, and then the year later, you're down 30 or 40, and then 18 months later, you're back up again. And then, it's just, that's the sort of type of markets, type of movements you can get. So, so I saw there's a few sort of guys talking about equities coming off 20%. And then I saw Stanley Druckenmiller saying that, he thinks equities could stand still here. But they won't sort of stand still. They'll be very volatile. So it'll be a real trader's paradise there.
Maybe on a 1, 3 or 5 year cycle, they might look like they stood still.
Yeah.
But
yeah, that's right. Yeah,
not on the daily chart. No.
Yeah.
So,
but the one thing Bill McLaren talked about is that when these sort of accelerations, when these blow off trends, came into place, he said, I'll always look out for, like, oftentimes you can get the last leg can be like a 90-day blow off, or this sort of 13 weeks can go straight up 13 weeks there. If you see the 13-week blow off up into a high, look out. That's exactly what we've just done here. So basically, I think New Hope today has gone up exactly 90 days from the last swing low. It's sort of made a new high here. So McLaren would be telling us to look out. So I'm not telling you to look out. I'm just saying I've seen this theory applied over the years, and I'm yet to see a vertical trend that once it's ended hasn't come back with in dramatic fashion. So if you're long some coal stocks here, all I'd suggest is to tighten up your stops. That's all. Just, you don't want to see this thing break down here.
Well, it could be breaking down quite hard and fast if the blow off tops continue with their pattern that you've only ever seen eventuate.
Yeah, but it kind of fits in with our sort of cycles a little bit there too. I mean, if we go on to the next chart there, Chris, we're talking about, this is, we're talking about sort of midterm years are quite unique. I've sort of, in that, in terms of the 4-year cycle, if we look every 4 years there, we can see these big lows occurring and the big rallies come out of this. So, the best 2 months, the best 13 months of the 4-year cycle are about, are only a month away. It's almost upon us here. So oftentimes we see around that October phase of each 4-year cycle, the midterm year, we see big rallies come out of those lows there. So that's that's inferring here we'll see a bit of a deepish sort of low, but then we'll see a really big rebound. And I can tell you, like, no one is forecasting 20 30-40% rally in equities here for the next 12 to 14 months.
Well, there's
Yeah. 20
and 30% being spoken about, that's for sure. But it's
On
negative, isn't it?
On the downside, yes. Yes. So it's interesting here. So yeah.
Well, this chart that you've got here, you've kind of broken it in two. So you've got us the 58 and the 86. It's great that you've broken it in two so we can fit it onto like in more detail. Is there any difference between this first half and the second half?
Look, like some of them more, are better than others. Not every year works. I guess that's the main thing there. So not every
4-year cycles.
Yeah, not every yeah. I will tell you an interesting stat is that the Dow Jones has on average the last 100 years rallied something like 49% over the next 14 months following that October. So it's I think it's 49% rally out of the October midterm year historically on the 4-year pattern. That's the average.
So how long is that investment to get that?
That's the year and 2 months. So basically that's the high in the next 14 months. So it's basically if we looked at the peak within the 14 months, that peak is on average around 49%. On the Dows, which is a pretty big stat. It's a pretty big number. Yeah. So, but that sort of matches up too. So whether that's whether it's a high inflationary period or not, inflation does peak. It does match up anyway, because we sort of know that markets have these. Even in high inflationary periods, we have these big, sharp rallies there. It just might mean a year later we might come back down again and have a really deep correction again, like the 70s. But hopefully by then we'll you might have more.
So bullish ETFs?
Well, you might have some more evidence around inflation. Has inflation really cooled off, or is it just marginally cooled off and everyone's got too excited about cooling off and it's still showing signs of hanging around? Or if it has really cooled off, then maybe equity markets can continue to go higher.
Like more macro data breakdown of energy versus jobs creation, productivity, supply chain constraints.
But there's some good economic data around. But there's obviously everyone's concerned by rates and stuff there. So But the one thing I sort of noticed with looking at interest rates in the past was that initially when rates started to move up, they always happened a lot faster, everyone thought, and markets got scared initially with rates going higher. But generally, rates going higher is normally a sign of the economy getting stronger normally. In this case, it is, but it also is probably not the primary reason why it's going up. It's going up because of inflation, which is probably scaring everyone as well. So if you can get that in order, and the economy stays reasonably robust there. The fear is the Fed's left it too late here. Central banks haven't moved fast enough, so they haven't got ahead of inflation. That is the biggest fear, because all the data has been pretty positive, really. If you look at job rate, everything else. So hopefully they haven't left it too late.
Yes, that is a good positive. We still have skills shortages domestically and internationally in many parts of the world too. So that's a good business metric normally. As you said, the economy's performing well, so that's why interest rates are going up.
Yeah.
Well, they're good overall, looking at patterns, the macro, the opportunities, what to look for in the trading opportunities. And you did touch on some of the topics that you went into detail again on Friday. So we'll put on the screen there that playlist, and then also a charting pattern that can work in this part of the cycle, which is springs. We've got on the screen here also your contact details for Gary Glover. And we'll come back again later in the week and an update next week for your report. Thank you, Gary Glover from Novus Capital.
Thanks, Chris.